There are 6 reasons I want to give of why I do not invest in bonds. The first, stocks go up more than they go down. So you have much better odds long term investing in stocks versus bonds.
If we look at the last 10 years of the S&P 500, only 2 down years, 8 up years, and we see a -6, almost a -1, but then the up years we see 26%, 28%, 29%, far more up than down. And if we take a look at the NASDAQ Composite Index Fund, last 10 years, we can see 1 down year, -4%, and that's it. The other 9 are up years, and we're looking at 21%, 43, 35, 28. Now take a look at the total bond market index fund admirable shares with Vanguard. We see, if we look at the past year, down -4%, and this is the bond index. Last 5 years, a 4%, not even, 3.65% return in the last 5 years. Now compare that to the index funds for stocks, huge difference.
The next reason why I do not invest in bonds is because the same amount of effort and research to find a better bond, you will hope to get around 3, 6, 7% if you're very lucky in a bond. But these high yield junk bonds, they do impose greater risk, and you could also lose money in these high yield bonds. The same amount of time and effort research into finding a good stock, you get a 20% appreciation annually on finding a stock that you think will perform well if you put in that same amount of time, energy, research. The next reason why I do not invest in bonds is because when stocks crash, the bond market also crashes. It just doesn't go down as much as stocks.
When the S&P 500, for example, crashed when the coronavirus came, we see it fell around this time, bottomed out around March 20th, and then subsequently it regained what it lost. At the same exact time the S&P 500 index fund crashed, we go to the total bond market index fund, and around that same exact time, March 20th, it also bottomed. The total bond market index fund, just like the S&P 500. Now, percentage-wise, it didn't crash as much, but it still crashed. Another point I want to make on this topic is that not every stock is as volatile. So you can invest in less volatile stocks if you're afraid of a crash and you don't want much volatility. We have measurements such as beta, and you could find that when researching individual stocks. So, for example, one of them is Procter & Gamble. If we take a look at their stock, how it reacted to the coronavirus crash, we can see a pretty steady stock the last 5 years. We see around the same time frame, it dipped from 126 down to 102, which is about 10%. This stock dipped, but not that much. Not as much as other stocks with higher PE ratios, price to earnings. Rather than investing in bonds, you can invest in defensive stocks such as Procter & Gamble, and we see also has a dividend yield which is currently 2.14%.
The next reason why I do not invest in bonds is because of dividend stocks.
That is dividend stocks that also have the stock growth.
So you have this option with dividend stocks that will pay, many of them will pay around 2 to 3%, which you could find, and that is typically what a good bond will give you on a given year. On a normal year, when interest rates are around 2%, you can get around 2% on a bond, but you can also get around 2% on finding a dividend stock plus the appreciation, as long as you don't need to take out the principal anytime soon.
I'm showing, for example, McDonald's, which is a solid stock, blue chip stock. And we see the current dividend yield is 2.05%. And if we look at the last 5 years, it appreciated 121.97%. So 2.05% dividend yield, that's growing.
Most blue chip stocks that pay a dividend also increase their dividends every year. So just by holding, your dividend yield is increasing by a percentage that usually beats inflation and also wage increases.
Right now with the federal interest rate at 0, so right now you're going to get nothing in bonds. But when the economy gets back to full tuition, you could expect the Federal Reserve to eventually raise the interest rates to 2%. As they increase it, the value of your bonds is going to decrease. When it goes up, when the Federal Reserve raises interest rates, you lose value in your bonds.
The next reason why I do not invest in bonds is because now we have online high yield savings accounts, which match what bonds get. And there's zero risk, so there's zero downside with putting your money into these high yield online savings accounts versus a bond where there is risk and there is volatility.
I want to show you high yield online savings accounts as of January 2022. This is with the current Federal Reserve rates of 0%. So you're getting pretty much nothing right now on bonds. Current high yield online savings accounts rates where you have zero risk. There's no volatility with online savings accounts. Bonds, there is volatility. You could lose money by investing in bonds, especially in the short term. So it's not safe. So let's look at what the rates are. So if we scroll down, we see most of them are given 0.5%, 0.5%.
I also would like to note that these online high yield savings accounts are also FDIC assured. So this means if the bank goes under, you're still assured your money. Not that these big banks are going to go under anyways.
And when the Federal Reserve raises the interest rate and you start to get more of a return, a higher yield from bonds, this also goes up with it. So before the coronavirus, these were at over 2%.
My last reason and why I do not invest in bonds is because historical trends, historical charts are not a good measure of the present and the future. And I may do a video just on that. But what I mean is, you see right now with the government, the political environment, the way things are operated, we saw during the last coronavirus crash that when the stocks crashed, we've seen the government respond by printing more money and inflating the economy, stimulus checks, bailouts, giving money to small businesses, giving money to large corporations. And this resulted in the total stock market index funds to recover all their losses from the coronavirus crash within about 6 months. So I feel that in the future, this will be the precursor of what will happen every time the economy crashes. Reason being, because many people have retirement accounts that are heavily invested in the stock market. And whenever the economy crashes, politicians want to get reelected. So what they will do is they will try to issue these stimulus checks, printing money into the economy so that people's retirement accounts can go back up because they have a much better chance getting reelected when people's money are not down, when they're going up, not going down. This also gives investors a sense of security investing into the stock market, because whenever this happens in the future with the stock market crashing, we probably can expect the same reaction, same response with printing more money, which will result in recovery of what you lost in stocks. If you found this video of value, make sure to hit that like button and consider subscribing. Thank you.